Every day you read headlines about businesses being hacked and intellectual property being stolen. That is cybercrime, and it affects each and every one of us. Microsoft created the Digital Crimes Unit to fight cybercrime. We use the Microsoft Cloud to visualize information so we can track down the criminals.
When it comes to the cloud, trust and security are paramount.
We're building what we learned back into the cloud to make people and organizations safer.
Let's go ahead and move topics and talk about opinion right now that's saying get out of stocks. Joining us today to discuss it a little bit more is David Stockman. David, hopefully you heard the conversation that we had with Jim Paulson before and also the trader commentary. I want to get your view. You're a little bit more pessimistic. Explain to us why.
Yes, I heard him talking about the wall of worry being climbed on Wall Street. I think it's the opposite. I think the frogs are in the boiling water again and don't have enough sense to get out. We have been trading in a range for the last 600 days, plus or minus 2060 on the S&P 500. We're at the cyclical top, both for the GDP, which we can get into, and certainly for earnings. The first quarter's in. Earnings on an LTM basis, latest 12 months, GAAP earnings were $87. The market is trading at almost 24 times. Why would you stay in? Maybe we get back to 2130, hit the old high. That's 2% up. There is a huge chance that the world economy is not recovering, as Paulson was saying, but slipping into a deep and lasting deflationary recession, and you can see that happening in China. If that happens, we are not immune. We are not decoupled. There's plenty of evidence that we're going to be in recession in the United States by year end or soon thereafter. If that happens, the market can easily drop to 1,300. That's down 40%. So why would you, unless you're a trader, a technical trader by the hour and day, why would you hang in a boiling pot where the upside is 2% and the downside is 40? I don't see it, but I think the reason it happens is that somehow Wall Street thinks they're going to be bailed out by the Fed, and I say it's out of dry powder, that they're going to have another fiscal stimulus after the election, and that will never happen because we're heading towards trillion-dollar deficits within a year or two as the next recession unfolds. Even Larry Summers the other day said we can't get through the next administration without a recession because they don't, expansions don't last that long. We're in month 84 already, and it's inconceivable that we're going to never have a recession again. They haven't been abolished. In fact, there's so many signs of weakness in the economy that it's kind of hard to list them all.
David, let's talk about the next administration or the possibility for a Trump presidency. How do you think he handles the markets? He's pledging himself as a businessman, someone who can turn things around. Do you still think, no matter what happens, no matter who's in charge, that a recession is pending?
Yes, there's no way the next president can stop a recession. That's baked into the cake. The only number that people hang their hat on is the establishment survey monthly number. Even that's weakening. But if you look at what counts, business sales, they're down 5% from the peak a year ago. You look at inventory ratios, they're at recessionary levels. Look at freight indices, rail or truck, they're in negative territory. Look at capital spending, it's rolled over. Look at auto sales, they have peaked for this cycle as well. And we've basically given everybody a car loan that can fog a rearview mirror. So the idea that this economy is somehow going to get stronger in the second half, or that the next president can forestall a recession that's already baked in the cake, I think is wrong. I do hope that if we're going to have a choice between Trump or Clinton, that we don't get another Clinton, and that what we really need is Donald the Disruptor, somebody to break the chains of the status quo and figure out a better way to do something than Wall Street and Washington have been drifting along with for the last 8 or 10 years.
So, David, a lot of points made there. Are you basically saying that you think Trump would be a better candidate? He'd be better for the markets?
No, I don't think he'll be good for the market at all because he's unpredictable and he is not schooled in all the illusions of the status quo. I think he'll scare the hell out of the market, but that's okay because the point of running this country, the point of economic and fiscal policy is not to make the stock averages go higher. That's a modern illusion. We never used to believe that back in the 70s or 80s or
So,
even
David.
90s. Yes.
David, are you predicting that if Trump is elected president, the stock market's going to tank?
No, I think the stock market's going to tank anyway, regardless of who is elected, and probably well before the election. And this general election campaign and the debates that are going to occur will not be confidence builders in any way, shape, or form. They'll show basically how threadbare Washington really is in terms of policy. And therefore, I think it's going down for the count long before we get to November 8th.
David, one of the concerns you've had in the past when we've spoken is job creation in this country. I'm standing at a solar field. This is one of the projects that is going to boost jobs. We've got the candidates on the platform saying that they're going to add to the infrastructure projects to help bring jobs to this country and help get people back to work. Do you think that the plans that they're making and the plans that are already in action here are going to work?
No, I don't think it's a issue for Washington to decide whether, we invest in coal mines or shale wells or solar fields or wind farms or any of the rest of it. That's what the market's supposed to do. That's the job of capitalism. Washington ought to get out of the way, both in terms of regulations and subsidies. But still, the underlying point is that real jobs in this economy are not growing. What I count as full-time, full-paid breadwinner jobs today are 71 million, half of the total that the BLS reports. The rest of them are part-time and health and so forth. And that number is lower than it was in January 2001 when Bill Clinton was leaving the White House. So in other words, in 16 years, the entire century so far, we've not created one net full-time, full-pay job, in manufacturing or construction or white-collar professions on net. That's what the problem is, and I can't see how more money printing at the Fed, more, an extension of ZERB even longer than the 90 months or so we've already had it, is going to do any good.
David, great to have you on the show. Thank you so much. We'll circle back with you again soon.
Okay,
Meantime, I want to get straight to Jim. You're trading the 10-year note for me out of this interview with David. Talk to me about how we played here.
Okay, yesterday, on the same day that the German 10-year yield was about 0.12, and we had a solid auction, which of course we had a solid auction because our yield seemed attractive compared to the rest of the world. There was a day that prices should have rallied pretty good. They rallied. They didn't. They got hit. Makes me think there's going to be a bit of a counter trend move here. So I think if you could sell the June 10-year at 130.25, a couple ticks above from where it is right now, with a target of 129.25 on the downside, one full point. And if it trades back above 131.09, that's where I'd stop myself out. Again, this is a counter trend rally. I said before I'm bullish stock market because every morning I circle that German 10-year and say to myself, if people are crawling over themselves to buy the German 10-year at that price, our stock market's got to look good. Consequently, risk on. That's why I think the curve could steepen a little bit.
I agree with Jim. On this trade right here, right now, I think we've seen a reversal in the 10-year. We've seen a reversal in the 30-year. And after a nice big rally, the market is a little overheated, a little quick. I think as well, and you're going to hate me for saying this again, you've got to respect the Fed meeting in June. And that's going to drive these prices lower in the immediate term. Once they don't hike, though, I do not see
yields going higher for long. You seem to be the only one who still thinks that, Bill.
I respect Bill, but I don't respect that opinion.
Yes. And that's why we're not going to see yields higher for longer.
Let's go ahead and get the bottom line on this trade. In terms of the 10-year note, Jim is selling it. He's selling it at 130.25, targeting a move to 129.25. Each tick in this trade, we're 31.25, so we're risking $500 to make double that. All right, my thanks to Bill and to Jim for a great show today, and certainly a really interesting venue here in San Francisco to do it from, raising a lot of provocative conversation when it comes to the energy trade and the markets in general. Remember, if you missed any portion of the show, head to the website, futuresnow.cnbc.com. Otherwise, we'll see you for our next live broadcast Tuesday, 1 p.m. Eastern. See you then.